Tanks have arrived from Fort Stewart in Georgia as part of President Trump's planned changes to this year's Independence Day celebrations. Contractors are setting up a
All right, so I'm not sure why that recording stopped, but just reporting here that there is going to be a big 4th of July celebration in D.C., and you might be surprised by my response to this. Oh, it started up again. There we go. You might be surprised at my response to this, but that's coming up later. Let's first go to positions here. Really, the VIX not doing anything. UVXY did get down to 27, I think like 01 or something like that yesterday. And I briefly tweeted out that I had, or I said somewhere that I bought some UVXY calls. And I did buy some December calls in UVXY on yesterday. I bought December 28 and 27 calls. And I actually decided to bail on that position. So I did buy 4 of the December 28 calls, and my idea was with vol down here, buy some calls and then sell something against it as time goes by to finance a position hanging around for a spike. So let's take a look for a second at UVXY and a sort of sample position here. And to do that, I'm going to get out of the way. So if we look at the chart for UVXY, we know it's at the all-time lows, and it's had a big down move. However, this could easily continue for a long period of time. So this trick is, how do you craft a position to take advantage when it does pop without just sucking wind forever and losing day after day after day as it goes lower until you finally get that pop? Well, the answer is, of course, the beauty of options can help you with that. I was looking at just buying some December calls. So let's play around with this analysis tab to illustrate some ideas here. So if we go and we buy some December calls, and I was thinking of at the money, but you could just as easily do out of the money. But let's say we bought some December 28 calls. Let's say we bought 10 of these. And I'm just going to widen this out so we can see the numbers here. And then, so I'm going to enter this into the trade ticket. Then I'm going to right-click on the side and go and analyze trade. That will pull these into our analysis. And you can see them here in the analysis, 10. And when we look at the deltas, this would get us long 600 deltas. Okay, it only costs us $20 a day in decay. However, the other problem is that this thing is creeping lower. And so each point it creeps lower, we're going to lose $600. So we got some amazing pops in UVXY this year. Let me tempt you with this. Look at these moves in the last 180 days. Well, that's UVXY. That doesn't look good at all. But if we back this out a little further, it starts to look a lot more intriguing. And maybe not even that one, but well, you see these pops. Big pop there, big pop there. And all we need is a pop that's a third of the size of one of these things, and this would be a huge winner. But in the meantime, this could just leak lower. So what do we do? Well, we can sell some front month stuff against it. Okay, so if we had bought 10 calls here, let's get rid of this theta. How can we get rid of this theta? Well, we could just sell some calls 9 days out, and we could pick calls that are out of the money, so we're not losing the chance if this does spike. We're not giving up all our upside. We could pick something like these, the 30.5 calls. So what happens if we sell 3 of these 30.5 calls? Let's see how many calls we need to sell to get rid of our decay problem, first of all. So if we sell 3 calls, we're down to $2 a day in decay. So if we sell 4 calls, now we're collecting $4 a day. So that's basically flat, accounting for commissions, whatnot. And we're still long 500 delta. So it's very easy to solve the decay problem. Now, what's the second problem? The second problem is that this thing is just leaking lower. So if you have a sense that it's definitely not going to spike this week, then you can sell stuff in the short term against your position. However, if you do that, then if you actually get the spike you're looking for, you're not going to make money. But you could just for the holiday weekend, maybe, or for the next week, maybe sell some of these sort of at the money calls. So what we're looking at here, importantly, is units. If we stay within the units that we bought, then we don't have any naked options. Now, not to say naked options aren't a possibility here, but let's just keep very close track of our units, because once we get into negative units, that's when you can have real problems in a spike. And the models for buying power and for margin and that sort of thing are not necessarily going to count these not as naked calls when because you've got different months here. So it's not, the model's not going to see this as these calls necessarily being covered. So, but we need to keep track of our units, because as long as we've got more long units than short, and it's not like the long units aren't super out of the money, then we're safe for the upside. I mean, another way to do it is just to look at the risk profile. There's the chart of the risk profile. We can go and look at it that way if seeing stuff graphically makes more sense to you. But yeah, so let's say we want to have this long on, but we want to kind of insulate ourselves for the next week. We could take the other 6 units we have and just sell at the money calls. So I could take and sell 6 of these at the money calls. Okay, now our delta is still long. Why is our delta still long? Well, because think about the model. The model is making these calls that we bought have a higher delta than the calls we're selling. So and also we've sold 6 at the money, but we sold 4 way out of the money calls. So we still have a long delta, but half of the long delta we did before. And now look at this. We're collecting theta every day. We're collecting decay. So if UVXY happens to leak a little bit lower, this $43 a day is going to help cover that leak down. And so all of a sudden, just by these 3 trades, you've got a nice little position on. Look, you're collecting money every day. If UVXY stays still, you're collecting money, i.e., on the 4th of July, it's not going anywhere because the market's closed. The weekend, next weekend, it's not going anywhere because the market's closed. So you can count that $43 or $44 for those 3 days as money in the bank. And this looks a little bit more attractive than just being long 600 deltas, like the equivalent of 600 shares, and risking this just slowly leaking lower. Now, if we do look at our risk profile here, we can see that we've got a lot more we're going to lose to the downside than we're going to make to the upside by selling these cheapo calls against this position. So, there's a kind of an internal debate. Okay, well, if you want to, get long UVXY because you think it's a very low vol and that there's a good chance of it popping from here, instead of buying 10 of these calls and selling 4 of these to get to your 200 deltas, it might just make more sense for you to just buy, just straight out, just only buy 4 of these December calls and just leave it and hang out and accept that yes, it can leak lower, but the downside risk is going to be like a slow moving, kind of slow creep thing, whereas the reward to the upside would be a big pop. But I like this idea of buying some of these calls and hedging at least some of them so that you've got positive decay. Because that way, if you're sitting around, nothing's really going on in the market, and UVXY is kind of hanging out, much like it is today, then you're actually profitable during that time period. And you still have the long delta for the pop. So this is a neat position. I kind of like this. Or some sort of derivative of this. Now, the other thing you could think of is, well, who cares if UVXY is at the all-time low? We're still in massive contango right now. Let's take a look at VIX Central for a second. So, the opposing view, and I don't think this is necessarily wrong either, is, and this is what I usually teach, we're at almost 9% contango, okay? So UVXY is 27. 9 times, 0.09 times 27. So it's decaying by 240 a month at this point due to this contango. So yeah, it might be at a low level, but it is really getting pulled lower rapidly at this point. So you know, so let's say, okay, well, I'm gonna put a short on, but I'm gonna put a short on that's a little bit long term. That way, I know that there's gonna be bumps in the road. We're gonna get a pop here and there, but in the meantime, this is gonna go lower, but I'm gonna give myself time to weather some sort of pop. So I might go out to, and actually for this kind of trade, I might actually go over to VXX just because there's more liquidity to get in and out of this stuff. At better prices. So you might go to VXX and look out to maybe January or December. Let's look at December. And we might say, okay, well, you know, we've made a big down move, but this thing is going to continue to go lower. 170 days, you know, if 30 days equals 2 points down, then 170 days equals a lot more points down, right? So you might say something like, all right, let's buy the 25-20 put spread in VXX with 170 days to go. We'll basically pay $3 to make 2, and you've got this long-term position on, and you know you can weather a few spikes and whatnot, and as long as we stay kind of in contango, it will be below 20 by December. So you might put this position on, and then you're hanging out. You love 4th of July. Nothing's going on. We're in contango, and you know the volatility's dampened, and you're just hanging out, and you have a longer term position, but you could make a percent that would make any professional trader jealous just by putting this one spread on and hanging out until December. You're betting $3 to make 2. Huge return for basically you just put it on and forget it. Let's see. I have a question here. I'm very anxious with my UVXY. I'm using margin. I have 1,600 papers and an average of 35. Now, I think what you mean is you're long 1,600 shares from $35. Yeah, the first thing I would recommend to you is in the future, I know it's too late now, don't use margin just because we want to constrain ourselves. We want to be disciplined ourselves, and the money you have is enough to be disciplined. My suggestion to you, and if you are in a situation where you're long 1,600 UVXY from 35 and it's down here, and people who know me will recognize this suggestion. And let me just pull myself up so that I can look at you when I talk here. And you know, I'm a very mechanical trader. You could predict, if you know me, you can predict what I'll do in any situation because it doesn't change. And in this situation, you know, you're not the only one who's been in a situation where you're long something and it's gone against you. And it's happened to me many, many times and probably on here. And my recommendation to you, if you are long something that's gone against you and it's gone a long way against you, is to, and you're not going to be happy about this, and it doesn't make you happy. It's not a happy situation, but my advice to you, which I think is excellent advice, would be to sell half of your position. Okay, and you're not going to be happy. Either way, you're not going to be happy with having done that because if it goes right back up again, then you've locked in a loss. If it goes down more, then you wish you'd sold more. I guess if it goes down more, you'd be happy that you sold half your position. But you sell half your position, 50% of your headache and problem is gone, and you can live with the fact that you've cut your problem in half, and there's less to think about. I can tell you from working with a risk manager for many years, for me as a market maker, I had a risk manager who was watching my positions from a risk desk and was looking at things like how much would we lose if this went up 50%? How much would we lose if this went down 50%? What if volatility exploded? And would look at my positions. And he used to say, I'm here to walk you in off the ledge. And And I know what my risk manager would say now. Having worked with one for many, many years, I can kind of hear a voice in the back of my head talking to me as a risk manager. And what a risk manager would say to you right now, if you're along 1600 UVXY down from 35, they would say, do something today towards making the situation better. Okay? So, maybe you don't want to sell half your position. Maybe you want to sell all of your position. Maybe you don't want to do anything. But my advice to you today would be do something today. Okay? That might be only selling 100 shares. It might be selling 500 shares, so you're just up to, or 600, so you're just long 1,000. But do something today to start working your way out of this. You got to do something. You can't just sit there and let this continue to go against you. We're all wrong at times. All of us. And if people say they aren't, then they're lying to you. These guys that come on with the channels and say that, we're in boot camp and all this stuff, whatever. Your situation is your own, and no matter how much money you have, you need to, I would say, I'd say sell half your position and move on. Take that loss, throw it over your shoulder, and go on to the next thing. All right, so I did want to talk about BYND and the BYND position, but let's talk about the rally and all that stuff in D.C. And there's been a bunch of controversy because the president wants to have this rally in D.C. with tanks and all this stuff. And we know that he was a witness to Bastille Day in France and was impressed by that parade there. We know that the government has, in the past, not allowed funding to do some sort of big military parade here. And my background, of course, is that I come from a political family. My grandfather was a state senator. My father is politically active in our community here. My uncle is an organizer politically for expatriates abroad, and we don't get along. I have both sides of the aisle in my family, and we get in huge fights, but the good thing is we are engaged. And I've told people before, I'm proud of the fact that on this channel there are people from both sides of the aisle, and I'm happy when you disagree with me and we engage in a conversation, because I don't think there is enough conversation between both sides here. I would say that the Republican Party does not have a monopoly on patriotism. First of all, I kind of see myself as more of a liberal than a Republican. However, in this particular instance, I think that there is nothing wrong with the president having this rally and stuff. I think that getting all upset about seeing a tank in the street is ridiculous. This country spends so much on our military. It is the hugest portion of our spending, and so much of our tax money goes into the military. So why deny that? It's the truth. Our military is a huge part of our spending for our government, and it's a huge part of who we are. And pretending that that's not the case is not really being honest. A. B. The 4th of July is about the Declaration of Independence. When we declared that we were going to be independent from England, that was before we actually were independent from them, but we declared it, and then we went and we got it done. Was based on military action. So I have no problem with the parade and having some sort of rally that the president wants to do. I think that is okay. I do have a problem with how much we spend on our military. I don't think we should spend as much as we do on our military. I think we could take some of that money and put it into education and other things. However, I have no problem with this parade. I think that it's fine, and all the discussion against it is ridiculous. I'm proud to be an American. I think there's nothing wrong with protesting. That's part of being American. And like I said, no party has a monopoly on the flag or on patriotism. So there's my view on the parade. I say fine to have the rally. So let's move on to BYND, and I'll stick to things that I know about. Last when we saw BYND, I was short some strangles. I was short September strangles, and I was short the 105 puts and the 190 calls and the 200 calls and the 210 calls. And yesterday, volatility came in a lot. I think the position was up 12%. And I said, okay, I'm going to take it off. And I covered the position that I had. And I closed it out, and I was like, okay, I'm done. And then I started to think about it overnight, and I said, wait a second. This was working for me. Why am I just bailing on it right now just because it's worked for me? You know, in the past, when something's been profitable, all of a sudden I take the money and that's it. But in this case, it seems like it's been working for me and I should just leave it and let it work. So what I did was I looked out at the months and I saw that November, if you look at those numbers to the right of my head on the screen, that is it's a volatility number for each month. If you look out, November is the highest volatility of all these months right now. And I suspect that that's earnings related or event related. But regardless, I picked November and I sold some strangles in November. So I had September strangles, but I switched it to having some November strangles here. And this is a small position, but I am short the November 180 call and the November 100 put. I also have a condor on in November. So that's basically saying the strangle is saying that I'm short one call and one put. The condor is saying I'm short one call spread and one put spread, but I'm basically betting that this is going to stay within a certain range. And the condor that I have on is the 105, 115, 165, 175. And I'm not sure how you name condors necessarily. I know butterflies, you name them by what you're doing to the wing. So if you are buying the wings of a butterfly, then you're long a butterfly. Condor, I think it's the same way. But either way, I'm short the inside and I'm long the outside of this condor, of this iron condor. So I'm looking for this to just stay still, and I'm going to keep hanging out because I think volatility is going to continue to come in this issue, and I think that it will continue to come in until we either get another big move or we get buyers, because these guys don't want to keep buying stuff. Let's take a quick look at time and sales today, and it looks like August 200 calls. We had a seller of 421. So that's premium sellers right there. Boom. I saw a big trade when I just looked at this. I would recommend pulling up on this options chain. Pull up volume and open interest because it's going to give you an idea of stuff going on. Like here, I'm just seeing here 580 of these July 140 calls traded. Now that's kind of interesting because that's a deep call. So somebody is maybe substituting these for stock. So let's try to research this trade. So how would we research this July call? We could go to options time and sales, and then we could filter for just July. So that was the 12 July. And then we see here's a bunch of trades on the 40 call. So they traded 1134. It was a buy right. So a buy right means that they bought the stock and sold the call. And I don't know. They could have been closing out, so they could have been selling the stock and buying the call to close it out. And this could be just a stock substitute thing where they're trying to get long stock, but I doubt that's what it is because the put is worth something. But interesting trade. All right, let's go back out and let's filter for trades in the months we're interested in, which is November and September. These are the months we're interested in. So we should be able to tell from our P&L if volatility is coming in or not. But another way to look at it is just to look and see some of the trades in these months. So I'm going to look at November, September, boom. And we've got someone buying November 55. That's a deep call, so that's probably like some sort of stock substitute. We've got just really small trade here. It looks like I don't see anything too big. The biggest trade is this November 55 call. And I think what this is it's somebody who bought these calls instead of stock at some point. You know, if you buy the calls, you're saving, $55 each, by buying the call instead of the stock. And I think that this person is probably just selling something that they were already long when I see that trade. But not a whole lot of trade in September or November. Not that surprising as we are kind of coming into the holiday. But, no trade is kind of good trade when you're short premium also. So Beyond Meat, I continue to be short premium. I have been looking at also Carvana as a potential for selling premium. Okay, so Carvana, look, it's made these huge moves recently. It got up to this level of 72 back last July. Then it ripped all the way back to 30 and then all the way back to 76. Now it's trading 63. Now this is there's high volatility. You can see it moves all over the place. So that creates opportunity in the options. However, this thing could and probably will start, continue to make big moves. So if you're going to play the game, you got to be ready for this to rip one way or the other. Now, volatility not super high in the 60s here, but I'm looking and it seems to have kind of caught a range a little bit here. And I was looking at just the August 65 straddle. So here we go, August 65. So you could sell the straddle for about 1150, and you maybe just sell that a couple times, and you just hang out. And if it kind of just stays in that area, then the straddle should come in a couple weeks to like $5-6. If we look, that August has 44 days to go. If we look at July expiration, July straddle right now $5. So once again, not super liquid. Pull up your open interest to see what kind of liquidity an issue has before you start trading it. The other way, which I like to show people that I scan for stuff, is I go to barchart.com. So let's look at that really quickly. Go to barchart.com. And I just I pull up options, and then I'm going to look at the comments later in just a sec, fellas. Nice to see everybody in there. Hey, Oliver, what's going on? All right, so I go and I look at highest implied volatility, and then I look down the list, and a lot of these stocks are going to be like $3 stocks. Now, there's not a whole lot I want to do with a $3 stock, so I'm gonna look for higher price issues, and we've got BYND is in here, and Tesla, of course. Tesla is a great one to trade because it is a monster. The volatility is high. It can do anything at any time. You got to be careful, but it's those ones where like anything can happen where the real money to be made is. I'm just going to quickly peek on ETFs and see what the biggest ETF moves are. And UVXY is right up there with VXX and Nugget. All right, so let's take a look at the chat here, folks. Who would you vote for president? Oh, you know what? I'm brave enough to say, to give a little commentary on that, on some things, but I'm not brave enough to say who would I vote for president at this point. I don't think, because I'm afraid I'm going to lose half my channel if I say, regardless of what I say, I think I'm going to lose half my channel. How about this? I will say that I'm generally voting liberal, and I believe that the progressive, that this country is being pulled, at least in the Democratic Party, this country is being pulled far to the left, and there is one person who is pulling it to the left the most, who interests me. That's all I'm going to say on that. November is when the lockout period ends. Nice. That's good information. Thanks, Oliver. I think that you're going to see people finding ways to get out of their stock, around the time of the lockout period. It's not like it's going to be one moment where all of a sudden it tanks. It's going to be like some people are going to be doing, well, I don't know if you watch Law and Order, but there's one Law and Order where this guy was like a CEO of a company, and it was going to have bad news, and he had done a risk reversal to cover his shares. So there's ways that you can hedge your long shares before the lockout period, and one of them is called a risk reversal. I know this is going to be something that a lot of you already know, but let's just go over it anyways for those of you who don't. So a risk reversal is when you sell a call and you take the money from selling the call to buy a put. And what it does, it's also called a risk collar. And if you do it right, it doesn't cost you anything, and it will hedge a long stock position. So for example, if we look at BYND, let's say that you had long stock and you couldn't sell it until November. So you can go to November, or even farther if you want to, and you can take something like you could sell like the 180 call for $8, and you could turn around and you could buy there's a huge skew here, but let's say buy the 80 put, okay? So that's almost even. You're collecting a little bit of money, but if you do this a bunch of times, this is going to get you short, and it's a hedge against your long stock. So you're selling this call to buy these puts, and if the thing really tanks, if the stock really tanks, then you're going to make a bunch of money on these puts that you finance with the calls. If the stock goes really high up, then your calls will get called away, but you will have the long stock at that point when it gets released to cover those calls. So this is a way that people hedge ahead of a lockout period. It's called a risk reversal, or some people call it a risk collar. And I don't know what the legality is of all this stuff. Obviously, if you had enough money, you could go out and buy puts, or you could possibly make a deal with like an investment bank and say, look, I'm locked out on this stock, but will you let me use it as collateral to buy puts or something like that? But the bottom line is some way or another, people are going to be able to start hedging or putting pressure. The sum total is beyond. There's going to be pressure on the downside from this lockout period coming into November. It's not just that one day. It's a period of time where there will be continued pressure on this to the downside from that. Now, it's not obvious, of course, whether that downside pressure from the lockout is going to be bigger than the upside pressure of people just buying the stock. It's not like a foregone conclusion that this is going to go down when the lockout period is over. Of course not. It's just another factor that plays into the supply and demand for this particular stock. We did see TLRY go lower after the lockout, and some things do go lower, but other ones don't. Other ones just completely ignore the lockout and seem to go higher on it. So, if you come into this, and I'm not saying that you're doing this at all, Oliver, I'm just using this to talk about. If you come into the situation and say, oh, there's a lockout period on the stock, I'm going to short it ahead of that, you're trying to outsmart the market, and the market is smarter than us. I mean, there's people there that figured this stuff out already, and it's already discounted into the stock. Let's put it that way. So it's something to be aware of. It's something that's out there, but it's not something that you or I can easily figure out to make a bunch of money on necessarily. So that's what the deal is with the lockout. But thanks for that information for November. We'll have to see what happens with this one. I mean, anything can happen. That's why there is premium and money to be made. Selling a strangle is a risky trade. I'm taking real risk, and I realize that. If we can look at the risk, one way of looking at the risk, if I just move out of the way, I'm almost finished with this stuff. Thank you for bearing with me here. Okay, so if we look here at where it says BP effect by our position, we can click on that. and this is going to show these numbers here where it says PNR. This is the percent move where if it moved this percent, then my account would go to 0. Okay, so if it moves past this percent at one gap, then I'm actually going to owe money to the clearing firm. So, having naked options means that there is real risk involved, and so, that's why it's scary, and that's why it makes money, because you have to take some risk to make money. So down 61%, my account would be at 0, and and that's out there. That's something that you have to live with. If you start a business, then you're taking risk. If you buy a property, you're taking risk. If you're trading naked options, you're taking risk, and that's part of the game. So I would suggest to people to start out that you maybe just sell put spreads, or this iron condor that I did. A condor is similar to selling a strangle, except in the end you can only lose so much. You're stopped out because you've bought an option. You sold one option, but you've bought another cheaper one that stops you out. That says, okay, well, the most I can lose on this trade is, if there's $10 between the strikes, is that $10. If you're selling a strangle, you can lose infinite to the upside. To the downside, stock can't go past 0, so you can lose whatever the strike is. The strike, whatever the price of the strike is, that's the amount of dollars you can lose on it. To the downside. To the upside, it's infinite. If BYND goes to 2,000 tomorrow, then I'm going to owe a heck of a lot of money to somebody. But, and if we could pull up the Analyze tab, this is interesting. If you look to a 10% up move, you see my BP effect here goes up from $12,000 to cover it to $17,000 to cover it. So up 10%, all of a sudden, my account needs 5,000 more in buying power to cover the position. So that's something that you should be aware of. And you want to look at this up 25%, up 40%, my account needs another, 17,000 in buying power to cover that. If this goes up 40%, I need to deposit $17,000 in the account, or I need to cover my position. That's all stuff that you need to know ahead of putting some sort of position like this on. Okay, well, this has been a little bit of a long one, but I hope you've gained some insight from it. Thanks for watching today. Put your questions on the bottom. Tell me who you would vote for. I am grateful. Let me just say that I'm grateful to have people watching who are from with different political perspectives. I value that immensely, and I am convincible. Make a good argument to me about policy, and I will change my mind. And I want to display that kind of attitude, and I hope other people will have the attitude of being convincible, regardless of which party affiliation you have or which side of the aisle. I know that the two-party system seems silly to people not in the U.S. because other countries have more than two parties, but thanks for listening, and I'll see you in the next one. Happy 4th of July, folks.